Welcome to your interactive study guide on business planning. In this session, we'll explore how businesses set objectives, secure finance, and manage costs and revenues to ensure survival and growth. A solid business plan is the foundation of commercial success, reducing risk and providing direction. Let's dive in. Business planning serves three key purposes. First, when starting a new venture, a plan forces entrepreneurs to think logically and spot potential problems before committing money, thereby reducing risk. Second, external finance providers like banks and venture capitalists require a plan to assess whether the business is viable and likely to repay loans. Third, setting clear objectives gives the business direction and allows managers to compare actual performance against targets, making it easier to take corrective action when needed. A comprehensive business plan typically includes several key sections. The executive summary provides a snapshot of the entire plan, highlighting the business idea, objectives, and financial requirements. The market analysis demonstrates that the entrepreneur understands the target market, customer needs, and competitive landscape. Financial forecasts show projected revenue, costs, and profit, which are crucial for assessing viability and securing funding. Costs are a fundamental part of business planning. Fixed costs remain constant regardless of how much the business produces, such as rent, insurance, and salaries. Variable costs, on the other hand, change in direct proportion to output, like raw materials and packaging. Understanding this distinction is essential for calculating total costs and break-even points. Remember, total costs equal fixed costs plus variable costs. Let's work through a typical exam question. A business sells 500 units at £10 each. Fixed costs are £2,000 and variable costs are £4 per unit. First, calculate revenue. Price times quantity equals £10 times 500, giving £5,000. Next, total variable costs are £4 per unit times 500 units, which is £2,000. Total costs are fixed costs plus variable costs, £2,000 plus £2,000 equals £4,000. Finally, profit is revenue minus total costs, £5,000 minus £4,000 equals £1,000. Always show you're working and don't confuse revenue with profit. Watch out for these common pitfalls. Many students confuse revenue with profit. Revenue is the total income from sales, while profit is what's left after all costs are deducted. Also, remember that cash flow is the movement of money in and out of the business. A profitable business can still fail if it has poor cash flow, for example if customers pay late. In extended writing, always link business planning to risk reduction to score higher marks. To recap, the business plan is a formal document that sets out objectives and strategies. It reduces risk, helps secure finance, and provides direction. Remember the difference between fixed and variable costs. Fixed costs stay the same, variable costs change with output. Revenue is price times quantity, and profit is revenue minus total costs. Finally, cash flow is about the timing of money movements, not just profitability. Keep these key points in mind for your exam.